Hi, welcome to Lesson 3, Mastering Technical Analysis. So, technical analysis is the primary method I use to anticipate price trends and to anticipate price direction because it is a study of the collective psychology of the market. In the short term, what drives prices up and down is emotions, the sentiment of the market. So, in times of fear, people tend to sell. In times of greed, people tend to buy. And people's emotions change based on their interpretation of news. So many people think that I've got to read the news, I've got to predict the news in order to make decisions. Well, to me, it's a complete waste of time because number one, you can't predict the news. And even if you can't anticipate how the market will react to the news. So, for example, recently, North Korea fired a missile right over Japan. Okay, now what would you? Now, first of all, you couldn't have predicted it, right? But it happened, right? The moment it happens, the market reacts instantaneously in a couple of seconds. And when it fired over Japan, everyone thought that the Japanese yen would fall, right? Because of the fear that Japan's going to get hit. Well, guess what? The Japanese yen rose. Why did it rise? Now, no one knows because it depends on how the markets interpret the event. And the analysts would then say after the fact that, oh, the reason the yen rose is because the Japanese yen is a safe haven. And in times of crisis, people buy the Japanese yen. And to me, that's complete bullshit, right? So basically, wherever the market goes, whether the market goes up or down, analysts will always find a way to explain it or to interpret it, which for us as traders, we're not interested why something happened. We're interested what's happening right now and how to capture trends in real time. So to do that, we have to look at technical analysis, reading chart patterns. Now, the important thing to understand is that technical analysis is not about predicting with certainty. You can't be sure what's going to happen. In the short term, prices are random. But technical analysis is used to anticipate the probability of price movements, which means what is more likely to happen than not. And over a large sample of trades, we'll be right more than we're wrong. But we can't be right all the time. And that's critical to understand. So there are three axioms to understanding technical analysis and why it works to generate high probability trades. The first is to understand that the market discounts all known information, right? So that's another reason why, to me, it's a waste of time reading all kinds of news that the US is going to increase interest rates. There's a North Korean crisis. There's a European debt crisis, right? There's no point reading all these things because whatever you read and know, everyone has read and known. And all known information is really priced into the market, right? So there's nothing you can read that can give you an edge over the market because the market is the leading indicator of all this information. So the market price is a reliable measure of collective human psychology. And like I said, market price is a leading indicator of all fundamental data, both economic and political data. So relying on fundamental news, right? Going long or going short, buying or selling based on news you read always causes you to react too late. And that's why the majority of people tend to buy at the end of the trend. By the time they read that, hey, the euro's going up and they buy, the euro has already gone up and they're buying at the top. By the time they're reading and they say the euro collapsed and they sell, the euro has already gone down. All right? So price gives us the immediate decision point, not the news. The next axiom of technical analysis is to understand prices move with the trend. When a price is on an uptrend, the probability is that prices tend to move higher. When a price is on a downtrend, the probability is that prices tend to move lower. So we always want to trade with the trend. Trading with the trend always gives us a natural edge in the markets. And that's all we need, an edge. Next, history repeats itself, okay? Now again, in the short term, prices are often random in nature, okay? But at times, it is not completely random. There are certain repeatable patterns you can recognize and exploit. So by studying chart patterns and indicators, we can anticipate probability of future price movements by virtue of the fact that certain price patterns repeat themselves. And that is the study of technical analysis. So once again, we are not about predicting with certainty. We can't be right 100% of the time. It is used to anticipate high probability price movements. And as long as we have a slight edge over the market, we are right more often than we are wrong, even by a slight amount, we'll be immensely profitable. So technical analysis is a study of getting that edge. And to do that, we use a combination of identifying trends, support and resistance levels. We're going to use moving averages, certain indicators, candlestick patterns, price action we call them, as well as many other things that we're going to look at. So let's begin the training. All right, so we're going to start this lesson by learning about the most basic, which is reading the price on the chart. And the price is reflected through candlestick patterns. So whatever charting software you're using, we're going to be using the MT4 software. I'm going to show you later on how do you set up the charts and how do you set up the indicators and the moving averages, okay? So the first thing on the chart is you can select candlestick pattern. So the prices will be reflected in these candlestick bars, if you will, right? You can see there are two kinds of candlesticks. You've got the green candles and the red candles, okay? And you have to select what kind of candles you're looking at. Now for Forex, I primarily trade on the 15-minute candles, M15. So what this means is that each candle represents 15 minutes of price action. So every 15 minutes, a candle closes, a candle is formed, right? After 15 minutes, another candle is formed. So this is 15 minutes, 15 minutes, 15 minutes, 15 minutes. So these four candles combined represent an hour, okay? So I primarily trade on the 15-minute candles, but I would also look at the hourly candles. And I click on H1, that's 1 hour candle. So you then see that each candle represents an hour, okay? So it doesn't matter whether it's a 15-minute candle, an hourly candle, or a daily candle, certain rules apply. Certain rules still apply about how you read the candlestick patterns and what they mean. So let me get down to that right now. So again, when you look at a chart, there are two kinds of candles. You've got the green candles and the red candles, okay? Now, whenever you see a candle that's green, it's a bullish candle, right? So what does bullish mean? Bullish means that the candle closed above the open, right? It opened at a certain price and closed above that, so it's bullish. So in that time frame of 15 minutes or hourly, the market was bullish, or it's going up, if you will, okay? So whenever you see a green candle, first thing is to look at the body, right? So this entire area is called the body of the candle. And when you see a green candle, the base of the body is the opening price, all right? So that's the opening price. And the top of the body is the closing price. So the way you would read it would be open, close. So again, it closes above the open. So it's bullish, it's going up, right? And you'll then see you see an upper shadow and a lower shadow. Some people call it wicks or tails, right? Call it shadows, right? So the upper shadow tells you the highest price reach within that time frame. That means within that 15 minutes, there was a highest price reach. And this lower shadow tells you the lowest price of that time frame, 15 minutes or hourly candle. All right, so that's how you read a green candle. And from the top of the candle to the bottom of the candle, it is called the range, right? Well, it's more for general knowledge. We wouldn't really use it that often, but understand that is the range of the candle. So once again, when you see a green candle, it's a bullish candle. And how do you read it? You start from here. So it's open, close, high, and low, right? Now, when you see a red candle, it's a bearish candle, which means it closed lower than the open. So it went down during that period. So when you see a red candle, the top of the body is the opening price. And the bottom of the body is the closing price. So notice it's the reverse, okay? For the green was open, close, red is open, close. Similarly, the upper shadow tells you the high of the candle, and the low of the shadow here tells you the low of the candle. So there we go. That's how you read candlestick patterns, okay? Now, If you take a look at, once again, this chart, notice that candles, just like people, come in all shapes and sizes. Some are tall, some are short, have big bodies, some have small bodies, some have long lower shadows, some have small upper shadows, some have long upper shadows, right? So all these things tell you a story. It tells you the emotions, the sentiment that's going on in that price, in that asset, right? In this case, it's the currency pair. So now there are many kind of candlestick patterns and many names given to them, right? Bullish engulfing, bearish engulfing, morning star, evening star, and many of them, right? But for the purpose of making money, right, and for the purpose of me showing you my strategy, all we're gonna be concerned about for Forex using my strategy are the pin bar patterns, because it's the only pattern I use when I trade Forex, right? I don't like to overcomplicate things, I like to focus on one approach, make money consistently, right? The pin bar pattern. So there are two kind of pin bar patterns. First, we have the bullish pin bar, and then we talk about the bearish pin bar, okay? So a bullish pin bar is a specific candlestick pattern where the body of the candle is relatively really small. Okay, so if you take a look at 1, 2, 3, 4, these 4 candles are all bullish pin bars. What do they have in common? They've got a very small candle body, where the open and the close, it's pretty close. Okay, so now notice I put it in black. Now what does that mean? It means that it could be a green body or a red body, it doesn't matter. What matters is the shape of the candle. Okay, that's why it's in black. So again, if this was a green body, it would be open there, open price, close, right? And it's pretty close, so it's insignificant, right? If it's a red body, it would be open and close, right? Small candle body, right? Same thing, small candle body. Now for these two cases, you can see the candle body is just a straight line. Why? Because the open and the close is the same price, okay? Now, the bullish pin bar has little or no upper shadow. So notice that there's no upper shadow, very small, no upper shadow, very small. So what does that mean? That means that the high of the candle was very close to the open and the close. So it didn't go up very high, basically, that's what it means, okay? But most importantly, a bullish pin bar is a candle where the lower shadow must be really long, relatively long. And what do you mean by long? Okay, long means the length of the lower shadow should be at least 2/3 of the range of the candle. So remember the range? The range is the top to the bottom. That's the range. So imagine that's one hole or 3 out of 3. Okay, so the lower shadow from here to here has to make up at least 2/3 of the range for it to be a valid bullish pin bar. All right. So I look a lot at bullish pin bars when I'm going long, okay? Because a bullish pin bar is a very bullish signal, and let me explain why. So when you see a bullish pin bar, what it means is this: the price opened somewhere here, right? And initially the price went down. Now why is it going down? Because the bears are pushing it down. The sellers are pushing it down. So there's more sellers than buyers, right? So sellers are pushing it down, pushing it down, pushing it down, pushing it down all the way to here. So the price is here, but it didn't stay there, right? Halfway during that interval, the bulls came in. The buyers started buying, and the demand exceeded the supply, and the bulls pushed the bears way up back to where it started. And by the time the interval closed, the price ended up where it started. So in other words, who won? The bulls won, the buyers won, because the sellers attempted to push it down and they failed. The bulls, the buyers pushed it up again and kept it where it was. So this tells you that the bulls are in control, the buyers are in control, demand is stronger than supply. And that's why when you see a bullish pin bar, there's a high chance the price is going to reverse up after this happens. Now, really important is the bullish pin bar must appear at the right context. Location, location, location. You cannot just see a bullish pin bar and just buy. No, it doesn't work that way. The bullish pin bar should ideally appear at a level of support. And I'll talk more about support and resistance in the lessons to come. But just understand that it has to appear at a support level where there's something supporting the bullish pin bar before it can reverse up. It can't appear out of nowhere. Okay? And ideally, the bullish pin bar should appear not just at the support, but at the support of a clear uptrend. And again, I'll talk about trends in a while. So basically, an uptrend is one where the price is going up like that. All right, it's a clear uptrend, right? Upward movement, and it makes like higher highs and higher lows. So the overall trend is up, but the price comes down temporarily and forms a bullish pin bar. All right, and it's at a support level. Then and only then is there a high chance the price will continue going up, and that's where I'm going to buy. Okay, so bullish pin bar has to appear at the support of an uptrend, make sense, and not anywhere else. All right, so that's the bullish pin bar. Now the opposite of the bullish pin bar is, oh, before that, let's look at an example. So sorry about that. Okay, so here you go. Here's an example of a bullish pin bar appearing in the right context. It appears at the support of an uptrend. Can you spot the bullish pin bar? I'll give you a few seconds. Take a look. Find it. Have you found it? Do you see the bullish pin bar? All right, you should see it. Ready? There we go. That's your bullish pin bar. Da da da. There we go. Okay. So notice that the overall trend is up. Now this is kind of like a downtrend over here. Can you see that going down? And this is a reversal of trend. The trend is just reversed. And I'll teach you how to use the moving averages to identify the change in trend, right? But for now, just understand that it shifted from a downtrend to an uptrend. So over here, from here to here is an uptrend pattern. And what happened? The bullish pin bar appeared on the uptrend, right? And it's finding support at these moving averages. So the moving average acts as a support. So it's kind of like supporting it, right? Supporting it. And then boom, it continues going higher, right? So that's a classic example of bullish pin bar at a support of an uptrend. And again, I'll talk more about moving averages and trends in a while. Just understand how to read the bullish pin bar pattern, okay? So the opposite of the bullish pin bar is the bearish pin bar. So bearish pin bar is a bearish reversal pattern. And I look for this pattern when I'm going short, when I expect the price to go down. So again, this is a specific candlestick pattern where, again, the body of the candle must be small, right? You can see a small candle body, no candle body, no candle body, right? Where the open and the close are the same price. Open and the close are very close, okay? For the bearish pin bar, there's little or no upper shadow. Oh, sorry, there's little or no lower shadow, right? So there's no lower shadow, all right? So no action going down, basically, right? But the upper shadow is really long and at least 2/3 of the range of the candle. So we see a very long tail protruding like that. And again, the length of that upper shadow has to be at least 2/3 of the range of the candle, and that makes it long enough. Okay. So bearish pin bars indicate price is going to go down after it appears. Now again, it must appear at the right context, location, location, location. Where should it appear? It should appear at the resistance of a downtrend. And again, it can't appear anywhere else. If it does, it doesn't mean anything. Okay. So what do I mean? So first of all, the overall trend must be going down, right? You must see the price going down, right? There's a wave going down, right? And as it goes down, it appears, okay, so that's the bearish pin bar. It appears at a level of resistance. So there's something resisting it, and it's usually a moving average, right? So once it's resisted, it will come tumbling all the way down, right? So that's when I sell. So let's take a look at the chart. So you can see from the chart, this is a very clear downtrend. Clear downtrend. And again, I'll teach you how to use the moving averages to confirm the downtrend. Right? You see the moving averages sloping down, that's a downtrend. And can you spot the bearish pin bar? Take a few seconds, take a look. There we go. That's your bearish pin bar. All right, there we go. So notice what's happening. So on a downtrend, and the bearish pin bar appears at the resistance of the moving average. In this case, the moving average is the 50 moving average, the blue line, and the 40 moving average, or sorry, the 80 moving average. So it's kind of resisting it, goes up, boom, comes down. So that's when we short and we take the trade down. All right. So again, for the purpose of making money with my strategies, that's all you need to know. Understand the bullish pin bar and the bearish pin bar. Alright, so now let's talk about identifying trends. And no doubt, one of the most important things to do is to identify the current trend of the currency pair the moment you look at the chart. If you can identify the trend, I can tell you that half the battle is won. Alright, you're going to make more money than you're going to lose as long as you follow the trend, which is going to result in a net profit. Because when a price is in a trend, the probability is that prices will continue to move in the direction. That's one of the laws of technical analysis. It's kind of like a river current, right? You always swim with the current. If you swim with the current, right, you've got a wind behind your sails, you will always move forward a lot easier. When I was young, one of my mentors told me, said that 3 things in life you never go against, right? Never go against gravity, right? If you don't believe, jump off the building and see if you can fight gravity. Number 2, don't go against the power of love. And number 3, never go against the trend, okay? So there are basically 3 kinds of phases in the market. And the first is known as an uptrend. An uptrend is a situation when price makes higher highs and higher lows. So over here you can see a clear uptrend where you can see the price makes higher highs. So these are all the high points, right? Higher highs. And it makes higher lows, right? Higher lows. There we go. So on and so forth. Higher highs and higher lows, okay? And again, on an uptrend, the probability is that prices will tend to move higher. So in general, we always want to buy on an uptrend. We always want to go long on the uptrend. And the ideal time to go long is when the price makes a temporary dip on the uptrend, okay? So notice as price is on an uptrend, it still pulls back, it still goes down. But every time price goes down, it goes higher. 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 So you always want to buy when it's near a dip, right? You always want to buy when it's near a dip. You never want to buy at the high of an uptrend because eventually it has to dip down before proceeding higher. Think of it as kind of like a wave pattern or like a breathing pattern, you know. You breathe out like so. You breathe out. You have to breathe in before breathing out again, right? So you want to buy on the breathe in before the price continues going up. And that's the general idea when you trade. Next, we have got a downtrend, right? Got a downtrend over here. So a downtrend is a situation when prices make lower highs and lower lows. So as you can see over here, this is a clear downtrend, right? Price makes lower highs. These are highs, 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 and they make what? Lower lows. Okay, so on a downtrend, notice every time price goes up, it goes lower. Price goes up, it goes lower. Price goes up, it goes lower. It makes lower highs and lower lows. And again, on a downtrend, the probability is that prices will continue going lower. All right, so you always want to sell or go short on a downtrend. Okay, and the ideal time to go short is when the price makes a temporary rally, all right, a high, right? So price goes down, rallies up, down, rallies up, down, rallies up, so on and so forth. So you want to sell at the rally, all right, somewhere there before it collapses. And again, if you take a look, you can see a really nice bearish pin bar, right? So that would have been a very nice time to enter, but we have to confirm there's some kind of resistance, as I told you about, right? You can't just sell it without any kind of resistance area, right? So we never sell the low, right? Because again, selling the low is really dangerous because when you sell the low, it tends to rally back up before going lower. So again, it's like kind of like the breathing pattern I talked about, right? So you breathe out, breathe in, breathe out, breathe in. So you want to sell on the breathing in to capture the next wave going down, the breathing out. All right. So we've got the uptrend, a downtrend, and the third phase would be sideways or trendless, a consolidation pattern when prices make same highs and same lows. So let's take a look. This is a consolidation pattern. So once again, in the consolidation, prices move sideways between a support level and a resistance level. So again, this is a situation when prices can't go beyond a certain level and it can't go below a certain level for some period of time. You can see prices want to go up, and then when it hits a level, boom, it comes down. Once it go up, hits a level, comes down. Once it go up, hits a level, comes down. So what does it tell you? It tells you that at this level, there is an imbalance of supply and demand. At that level, there are more sellers than buyers, and sellers are waiting at that level. So the moment prices go up to that level, sellers will rush in to sell, supply exceeds demand, and boom, price comes down. And we call that a resistance zone. Resistance zone, where price finds it hard to go above that level because sellers are waiting there, right? Psychologically, people sell when it reaches that level. At the same time, if the price wants to go down, it can't go down beyond a certain level, right? So price goes down to this level and boom, goes up again. Price goes down, goes up again. Price goes down, goes up. Why? Because it tells you at this level, right, there are many buyers waiting. Right? Buyers are waiting to buy at that level because psychologically they feel that it's cheap, right? So it creates what we call a psychological support level, support zone. Okay. So once again, support and resistance represent key psychological levels where the forces of demand and supply meet, and there's an imbalance, right? So at support, more demand than supply; resistance, more supply than demand, right? Creates this kind of like ping pong pattern. Price ping pongs, right? Now eventually, right, price will break out of that consolidation, right? Either break to the upside or break to the downside. Now you never know what's going to happen until it happens, right? You can never predict the market. You can only follow the market. So in this case, you can see that price breaks above that resistance eventually. Why? Because it tells you that suddenly, right, there were enough buyers to overcome the sellers that were keeping the price at bay, right? So buyers rushed in and it pushed the price up. So it broke out of that consolidation, and notice something interesting. If the price comes back down again, that previous resistance becomes support, right? Boom, 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 goes up, right? So resistance becomes support. So similarly, support becomes resistance, right? If the price happens to break this support will become resistance. If the price goes up, there's a high chance it will hit that resistance and not be able to break it or even come down. All right, so that's a phenomenon that is really important to understand. All right, so let's take a closer look at support and resistance to understand the concept at a closer level, right? So once again, what is support? Support is a price level at which demand is thought to be strong enough to prevent the price from declining further. All right, so in this case, you can see a level of support here that prevents the price from declining further at a particular point in time. So when the price hits the support line and fails to break it, it creates bullish momentum. So kind of like someone jumping up and down a trampoline, right? When you hit the trampoline, what happens? Boom, you bounce back up again. So whenever the price cannot break that support level, it creates temporary bullish momentum, right, going up. So there are traders that buy the moment a support level is hit, right? So they see a support being hit, they'll buy somewhere here, they'll buy somewhere here, but they'll take a quick profit somewhere at the high of or somewhere at the resistance level. So we call that trading the range, buying at the support and quickly selling at the resistance. So there are traders that do that, and I don't primarily do that for Forex. I do that for more of the stock market. But for Forex, I use a different strategy. I tend to follow the trend than to trade in a range. It's just my style, right? So again, but eventually, when a price breaks a support level, what happens? That's right, it creates bearish momentum. It's like you jump up and down that trampoline, you jump up and down your bed, right? Eventually, when the bed breaks, what happens? Right, you go through with the bed. That's what happened to my daughter recently. She jumped up and down her sister's bed, broke the whole bed. She forgot that she's now bigger than a couple of years back, right? So you can see over here, price eventually breaks that support level, which means suddenly there were more sellers than the buyers could handle, right? And the sellers overwhelmed the buyers threw in the towel, and the price collapsed, right? So whenever a price breaks a support level, it creates bearish momentum. And again, there are traders that tend to sell or short the moment they see the break of a support level, right? There are traders who do that. That's not really my style, but again, that is a strategy that some other traders use that you may want to be aware of. All right, so again, the opposite of support is resistance. That's right. So resistance is the price level at which selling is thought to be strong enough to prevent the price from rising further, right? So as I mentioned earlier, price is going up, right? But enough sellers at a certain level pushes the price down, right? Pushes the price down. So that creates what we call a resistance level. And when price fails to break a resistance level, it creates temporary bearish momentum. It's like kind of like you jumping up and your head hitting the ceiling and you go out, right? Your reaction is out and you go back down, right? So whenever price hits a resistance and it cannot break it, like so, especially if you see like a bearish pin bar, can you see the bearish pin bar candle over there? Right? Especially when you see something like that, right? There's a high chance the price is going to reverse back down. So again, there are some traders who sell the moment resistance is hit and cannot be broken, and they see some kind of like a bearish candlestick pattern, like a bearish pin bar, they would sell short and take a quick profit when it hits the next level of support. So again, that's how they trade the range. Now, eventually, if price is able to break that resistance, like so, what happens? That's right, it creates bullish momentum, and that's called a breakout pattern. And again, some traders, they wait for a breakout above a resistance and they start buying it to catch the new trend, right? I do that for stocks, but I don't do that for Forex. And I'll teach you my specific Forex strategy, which is very, very powerful. It follows the trend. So I don't really buy breakouts, but just to understand that this happens, right? And there are traders that trade the breakout, okay? Now, another important concept to understand, and I use this concept a lot in trading currencies, which is testing of support and resistance. So when I say that the price is testing a support, what does it mean? It means the price is going to the support and it's bouncing off the support. And the support is preventing the price from going lower. That's what I mean by testing. And a great test is when you see the body of the candle remaining above the support level, but the lower shadow goes below that support. That is a strong test. So in this case, you can see the body of the candle remains above the support, but the lower shadow cuts below the support, and that is a very strong test. Why? What does it mean? It means that the price opened here, right? And the price initially went below the support level. So it's like breaking below the support. But it could not remain below the support because buyers came in and pushed the price back above the support, right? Buyers saved the day, and the price eventually closed above the support. So that's a very bullish pattern. Tells you that the sellers were not able to keep it below the support. Buyers came in and brought it back above the support. So that's what we call a strong test. So oftentimes when price goes down and you see a test, it tends to bounce back up. So again, here's another test. Now this is not a very good test. Why? Because in this case, the body of the candle closed below the support. So the price opened there and it closed there. So the sellers were successfully able to close below the support and break the support. So that's a bearish pattern, right? You want to see it close above the support, right? Recall open, price is here, close is there. Open is there, close is there. So close above the support, only the lower shadow goes below the support, gets rejected from the support, all right? Now similarly, you can see that this is testing the resistance, right? Price goes up and tests the resistance, right? And it comes back down again. Okay, so again, what's a good test? A good test is one where the price is not able to break the resistance, right? So it then fails and comes back down again. And a good test is one where the body of the candle is below the resistance and only the upper shadow cuts the resistance. Again, what does it mean? It means that the buyers attempted to push the price above the resistance. They say, oh, we're going to break it out, break it out, break it out, we're going to break out, start a new uptrend, right? But they weren't successful. Sellers came in and sold, and the sellers pushed the price back below the resistance. So the buyers couldn't get above the resistance, right? They're still not above water. And this tells you that the sellers won. So oftentimes when this happens, the price will tend to go back down again, right? Because it couldn't break the resistance. Same thing here, you can see a test of the resistance, right? The body of the candle remains below the resistance. Only the upper shadow was able to break through, but it couldn't sustain. Sellers push it down again. In this case, the price opened here, bullish candle, and closed here. So the price closed above the resistance. So it tells you that it's the buyers succeeded in keeping the price above the resistance, and this tends to be a stronger bullish or more of a bullish pattern, right? So again, when we're going to go long, we're buying, we're looking for a test of the support to go long. When we're going short, we're looking at a test of the resistance. Get it? Great. Right? Now, the other thing to understand is that support and resistance levels are not precise level that the market must scientifically obey. Right? So it's not like a brick wall where the price goes to the exact price and boom, and goes back down. Right? It's not a brick wall. It's kind of like a fence. You know, a fence. The price hits the fence and the fence goes boom. Right? So you got to give a bit of buffer. It's more of like a zone than a line. Right? So we call them price zones or levels rather than lines. Okay. So oftentimes the market penetrates the support or resistance levels by a small measure. So you got to give a buffer. Okay. So in this case, you can see that this was a resistance, right? And the price did not exactly touch it and go back down, right? It went above it, right? So it went above it, all right? Touched exactly, went above it. So you got to give it some kind of a buffer, like so, okay? Similarly, you can see, again, this is a resistance, okay? And the price touched the resistance, and went above it for a while, came back down, above, came back down. So it's kind of like a fence where it will sometimes go beyond the fence, and the fence will then push it back down again. So it's not a precise level, okay? So here you go, this is support, support, and support again. Sometimes the price goes slightly below the support, like so. Okay, and that's why new traders tend to get caught in false breakouts, right? They thought, hey, resistance, 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 breakout, they buy, boom, they die, right? Or they say, hey, yeah, it's okay, it's a support, breaks the support, short it, and boom, it goes up and they die, right? So that's why it's really dangerous to buy breakouts and short resistance and short supports if you're not very experienced because of these false breakouts, right? The market's kind of like in sports, like to fake you, right? So it fakes you going up, come back down again, right? Fakes you going down, goes back up again. So you got to be very experienced to trade these breakouts, right? So anyway, we're not going to trade breakouts in Forex. I'll teach you a much easier strategy, more powerful with a much higher win rate than breakout patterns, okay? So that concludes this part on support and resistance. Let's move on to the next part of the lesson.